Hey, Abby, it is very good to see you. We're tackling a really important question today. Are annuities a good investment? As stocks struggle, sales of annuities reached record highs in the second quarter of 2022. Actually, 77.5 billion. That's the highest quarterly sales ever recorded. We've talked a lot about the importance of creating stable income in retirement. So I want to start with fixed rate annuities. What are they?
Right. So fixed rate annuities, they're actually the ones that got the biggest bump. So they have exploded in popularity this past year. A lot of that is because people are looking for safety,
Right.
especially with the volatility we've seen in the market in the past couple of years. People want some principal protection. So that's the first thing about fixed rate annuities to remember is that they are principal protected. Second thing is that there's a set term that you choose. So typically they're anywhere from 2 years, all the way to 20 years if you wanted to do that for some reason. But they can be shorter term, which is very attractive to a lot of people. And then of course there's the set rate for the term. So right now what we're seeing is fixed rate annuities or multi-year guaranteed annuities, MIGA as they're often called, are offering interest rates that are 4 times higher than what CDs are offering right now.
Wow.
So they're a really good option for CD replacements, money market that's just kind of sitting there, lazy money as we call it. And I think that's one of the reasons they've really exploded this past year. People are seeing the place for them finally.
Yeah, interesting. All right, so talking about fixed rate annuities, they are on one end of the risk spectrum. On the other end, we have variable annuities. What are they?
So exactly, you're right. So with fixed annuities or multi-year guaranteed annuities, they're principal protected. They have a set rate. Variable annuities are kind of the opposite of that. I like to describe variable annuities as it's kind of like mutual funds with a insurance or an annuity wrapper around it. So it can have some guarantees, but the main part, the principal, does go up and down with the market. So there is some fluctuation there. And there's some people like them because there's a little bit more opportunity for growth because you are actually invested in sub accounts, which are kind of a variable annuity version of mutual funds.
Hmm.
But you do experience the downside when there's
Hmm.
volatility. So very different than a fixed or a multi-year guaranteed annuity.
Yeah, okay. And then the annuity right in the middle there, indexed annuities. Explain that, please.
Yep. So an fixed indexed annuity, they have a couple of different names for them. They're kind of like a mixture between a fixed annuity and a variable annuity. So with the good fixed index annuities, they've taken the best aspects of a fixed annuity, the best aspects of a variable annuity, and blended them together.
Hmm.
So, first thing to remember is that it is principal protected. So, that fixed part in the name, that means that you are not going to lose money when there's market volatility.
Hmm.
So, the worst you can do, if the market goes down, is stay right where you were the year before that. So that's kind of the fixed aspect. There's also a fixed option in most fixed index annuities that is, you can put your money in there for 1 year if you think that the market's not going to do very well, and you'll get that guaranteed. So that's another fixed component to it. And then the index part is the different part. So it's linked to. There's a lot of different options depending on the type of annuity, the company, all of those different things. But
Hmm.
essentially, the index is an external index. So we like to use the S&P 500 as an example because it's the most common index.
Right,
Everybody knows it.
right.
So you can actually choose to uh, kind of hitch your wagon or a portion of it, 30%, 50%, 100% to the S&P 500 index. And then if it goes up, you get a portion of the gains. If it goes down, you're protected from the losses. So that's
Hmm.
kind of the trade-off there with the fixed index annuity. There's the fixed component and then the index component. And then the annuity part, so the last part of that name, is the income portion. So some of them you can either add on to it or they're built in with a lifetime income component.
Hmm.
So that basically creates like a private personal pension for yourself and even your spouse if you choose to do joint income, and it can create some lifetime income while still having your pot of money there. So it's not like the annuities of the old, where if you start receiving lifetime income, your money is gone. It's still there, but you're receiving the lifetime income at the same
Okay.
time. So
Okay.
they've changed a lot.
Yeah, no, that's interesting to learn about. So you mentioned them as a possible replacement for like CDs or money markets. Would you recommend risk-averse investors allocate a portion of their bond portfolio to annuities?
I definitely recommend taking a look at it. So
Mhm.
there are pros and cons to everything in life in general. So some of the things that people don't like about annuities is that they're not fully liquid. So there is a term, and like I said, it could be anywhere from 2 years to whatever 10 years, whatever term you choose, and there's going to be restricted liquidity in that. So you might be able to take out 10% of your investment, or maybe 5%, just depending on what it is. So people need to be comfortable with leaving that money in there to grow for the term. So that's one thing that has to be considered. And then also people need to understand and be okay that it is a more conservative investment, especially with the
Right.
fixed rate. You could be getting 4 or 5% or whatever it is, and maybe the market goes up 10%. You're not going to get the 10% because you have that protection. So it's not necessarily a replacement for the growth part of your portfolio, like the stocks, but with the bond part, which is typically a big part of retirees' portfolios, or those that are right at retirement.
Right.
Bonds have really struggled in the rising
Mhm.
interest rate environment.
Right.
It's actually been a positive thing for fixed annuities and fixed index annuities. So it's a way to take advantage of this environment. And then also, bonds are not principal protected. Bond funds are not principal protected, I should say. And the outlook for bonds, US and global, is a lot lower as far as rate of return expectation the next 10 years than it has been in the past. And so the
Right.
traditional 60-40 portfolio is not going to cut it anymore. And so
Right.
we recommend come and talk to us. If you have a high allocation to bonds, especially, it's time to look at some alternatives, and see if we can increase the rate of return, lower your risk, the market risk that you're exposed to, increase your income. There's so many different options, and it's definitely worth taking a look.
Yeah. And so you may have answered this already, but I just kind of want to drill down in case I understand there's no cookie cutter answer for everybody, but what are the scenarios then when you're suggesting annuities to your clients?
So one thing that is an indicator that it might be a good fit is somebody that is risk averse,
Hmm.
or at least doesn't want to take 100% of their portfolio and put it in stocks. So
Hmm.
these are typically going to be our clients that are near retirement or in retirement. So looking for preservation. They want to grow their money and continue to be able to live the same lifestyle that they have, but they don't want to take the same risks that they
Right.
used to. And so that's a scenario where we look at what's a combination of all the different options out there. What's a good combination to recommend to these clients. So that's a scenario. And then also, like we were talking about, if there's a pretty high allocation to bonds, we can most likely replace at least a portion of those bonds with something else, with an alternative, like a fixed index or a fixed annuity, and have them in a much better position.
Hmm.
And
Hmm.
then one of the other scenarios we look at is if they have a pension, but it doesn't cover all of their expenses, or maybe our clients don't have a pension at all, we look at covering at least their basic expenses with guaranteed lifetime income. And that's going to be an annuity. There's really
Hmm.
no other financial instrument that does that. And so
Hmm.
that's one of the things that we look for as well.
Great. Well, this was really helpful to walk through not only all these options, but the different scenarios where they may be warranted. What I'm hearing is that it should be a conversation with somebody. So, Abby, if somebody would like to have this conversation with you, what's the best way to reach you?
Yeah, definitely. It's always a different recommendation depending
Right.
on the
Hmm.
situation. So you can always reach out to us at 678-442-0255. I'd be happy to speak with you about your questions.
Hmm.
Or you can visit us at theretirementfamily.com. You can send us a message, let us know what's on your mind, and we can schedule a call to talk about, what's important to you and what
Right.
you would like to talk about.
Great. Okay, Abby, thank you.
Thanks, Erin.